Let's first define what is a business group. And we'll try to differentiate a business group from a conglomerate, a conventional conglomerate that you come across in a relatively more advanced or developed nations. A business group is a bunch of firms promoted by a common stakeholder. It could be a listed firm or an unlisted firm. However, there would be one common stakeholder, popularly known as the promoter of all these firms, who may have a majority of ownership or a minority of ownership in all these firms. However, if you take a conglomerate, it's also a set of a bunch of firms. However, the difference is that the ownership, 100%, lies with one promoter of all these firms. In other words, all the other firms are subsidiaries of this common firm. That's the difference between a conglomerate and a business group. Now, the second thing is why you find these business groups mainly in developing economies like India or, say, for example, Latin American markets, and to some extent most of the East Asian markets. There are a lot of theories. One convincing theory is that the external environment facilitates firms to operate optimally in the form of business groups than being standalones. And the logic here is that when you have external environment that is less developed in terms of the labor, capital, and product markets, then it's not optimal or feasible for firms to raise inputs from the external environment. Like, for example, if the capital market is not well developed, then you are better off asking your friends or the firms in your network to fund your future expansions. In other words, rather relying on external capital markets, you prefer relying on internal capital markets. And so if you keep relying on internal product markets, labor markets, and capital markets, then you're better off forming firms as a group than being a standalone. And that's the rationale for the formation of business groups. So this theory also conveys a message that as we progress, you tend to see less of groups and more of standalones, simply because as the external markets become more competitive, you don't need to be a business group. And the corporate governance angle for a business group is very important, because given that all these firms, for all technical reasons, are independent, except that they have a common one shareholder, the remaining shareholders are totally independent. However, given that there is one common shareholder who controls indirectly or directly all these firms, there is every chance that there would be a divergence of ownership and control by the common shareholder, and that might facilitate expropriation activities by the common shareholder or the promoter of a given. As explained earlier, given that these firms have cross holdings in a business group setting, so there is every chance that the common shareholder or the promoter of this group can expropriate funds by tunneling funds from a firm where the promoter has lower cash flow rights to a firm where the promoter has higher cash flow rights. And this can happen when promoter has more control rights or voting rights compared to the cash flow rights of the promoter. Well, this can be taken as a negative signal. However, you have to keep in mind that when the market is not fully developed, it also implies that when you have a problem, then you're co-insured through a group. In other words, it's not just tunneling alone that happens in groups. Groups also prop their affiliates. So you have one positive aspect in terms of co-insurance, and you also have a corresponding negative aspect in terms of tunneling. So you can't really draw any negative connotations or poor corporate governance image when you're dealing with a firm that is affiliated to a business group. In the long run, if the propping activities even out with tunneling activities, then there is every chance that group affiliates can survive better compared to standalones. So then if the net effect is zero, it's not all that bad of being affiliated to a group firm for a long-term investor's perspective. Whereas for a short-term investor, there is every chance that you are taking more risk compared to a standalone by getting involved in a group. But the bottom line here is that the external environment, in any case, doesn't facilitate a standalone to operate in an optimal fashion. Yeah, let me extend my discussion on how group affiliation can affect investors' wealth. Let's assume you are an investor of Tata Tea, for example, and Tata Steel decides, and it had, in fact, acquired Chorus. So when Tata Steel announces their interest to acquire Chorus, there is every chance that you may observe all the affiliates of Tata Group, for example, TCS or Tata Tea, etc., react to Tata Steel's decision, even though they have unrelated businesses to start with, and they are independent technically to a great extent. Well, the reason could be that Tata Tea might have been an investor, or Tata Tea might be owning a stake in Tata Steel. So as an investor, Tata Tea reacts to the decision of Tata Steel. So when you are investing in a group firm, you have to bear in mind that you take not only the firm level risk, but you also take the group level risk. Right. So for an investor, that's very important to understand, especially if they're investing in group firms. So extending my market reactions discussion in my previous example of Tata Group, market reaction is nothing but change in the wealth. So if there is a market reaction, let's assume that there is a positive market reaction. It means that there is more money now to distribute to the stakeholders. Likewise, if it is a negative reaction, it means that there is less money to distribute to the stakeholders. Right. So in a way, a firm is quite sensitive. Our firm's wealth is quite sensitive to any given market reaction that might affect the firm value. So in other words, market reaction acts as an external mechanism of control of a firm's corporate governance. For example, there are many mechanisms that are external to the firm. However, they control the governance of the firm. For example, the regulators. Likewise, the covenants when you issue debt. However, all this boil down again to market reactions.